What's up, Graham? It's Guys here. So when it comes to the housing market, we have some good news and some bad news. Because in the last 30 days, despite ever-increasing mortgage rates and home prices falling by the largest amount since 2011, new forecasts now show that there's a higher likelihood of prices beginning to rise throughout the rest of the year. And even though this sounds like a crazy episode of The Twilight Zone, experts are also beginning to warn of a new housing problem that's beginning to affect the entire market, creating almost like a reverse crash depending on where you live. That's why we got to discuss exactly what's happening, the latest data that was just released, the largest price changes depending on your location, and why this Las Vegas property company renamed their streets after Pokemon as soon as you hit the like button and subscribe, because it helps out the entire channel tremendously and it takes just a split second if you haven't done that already. So thank you guys so much for doing that, and also big thank you to Rocket Money for sponsoring this video, but more on that later. Alright, so before we go into the precise numbers, all of this really begins with a very underrated aspect of the housing market, and that would be seasonality. See, even though housing prices generally trend higher in the long run, once you begin looking closer, you'll begin to see that there are consistent, predictable price swings that happen on a regular basis. And as you're about to see, we are in the middle right now of one of the busiest times to buy a house. According to the National Association of Realtors, data from the last 3 decades suggests that buyers are more likely to move and buy a house throughout the spring and summer, leading to a mid-year feeding frenzy of homes that drives prices upwards. Now, even though most seasonal pricing tends to lead to a sales price difference of 8 to 12% off the peak, some locations like the Northeast and Great Lakes lead the nation with a 22.1% variation between summer and winter sales prices, which means right now is probably going to be the most competitive it's going to be throughout the entire year to buy a home, with just under 70% of all sales activity taking place in just a few of these busiest months. Although speaking of getting homes under contract, here's where things take a rather unexpected turn. Despite nearly 1/3 of homes selling over asking price, the average home receiving 3.3 offers, and 25% of the market bringing in all cash deals, home prices have fallen last month for the first time in 6 years. Except this trend downwards is about to get a lot more complicated simply because the number of homes on the market is shrinking really fast. The chief economist at Realtor.com was quoted as saying that this week marks the first time that there were fewer active listings compared to a year ago in more than a year, which is a key reason why home prices have barely budged since the peak. In fact, what's remarkable is that new listings were down 29% this week from a year ago, despite a recent uptick in seller confidence. Meaning, even though sellers are getting a lot more optimistic about the value of their home, they're still refusing to move. All of this at the core really comes down to what's called months supply of inventory, which simply refers to the number of months it would take for all the inventory to sell at current levels. So for example, if there's 1,000 homes on the market, with 200 homes being sold on a monthly basis, you would have a 5-month supply. Generally, the rule of thumb when it comes to this is that if there's more than 6 months of inventory on the market, it's a buyer's market, whereas if there's less than 6 months, it's a seller's market. Although today, the numbers are heavily skewed towards the seller. A recent report from Realtor.com found that the number of homes on the market in June was down more than 47% from the typical amount pre-COVID. And for existing homes on the market, current inventory stands at just 2.6 months worth of supply. Because of that, home builders are beginning to fill the void, with new constructions now making up 1/3 of the total market inventory compared to just 13% in the years 2000 to 2019. Or I guess in other words, home prices are effectively crashing upwards just because there's so few properties on the market in the first place. And all of this is simply because of a term called the lock-in effect. The fact is, 92% of homes with a mortgage have a rate below 6%, and 62% have a rate below 4%. So instead of selling and being forced to take out a mortgage at a much higher rate, sellers are choosing to stay put with golden handcuffs, and as a result, fewer homes are sold. As proof of this, a separate study found that just over 27% of sellers who are considering listing their home in the next year would feel a lot more urgency to sell if rates dropped to 5% or below, and 49% would be likely to list if rates were to drop to 4%. On top of that, existing mortgage rates are also found to matter a lot. For example, someone with an existing mortgage at 2.5% to 3.5% would be much more likely not to sell than someone with a 5% mortgage. Not to mention, 60% of homes homeowners with a mortgage have only lived in their home for 4 years or less. So with the average length of homeownership at 13.2 years, statistically, we still have a long ways to go until those people begin to sell, especially with high mortgage rates keeping 1 in 7 homeowners from letting go of their home. This is why home prices nationally have barely fallen despite mortgage rates having skyrocketed. It's also why this is the second time since last August the sale to list price ratios hit 100%, meaning the average home is selling for exactly the price it's listed for. Now, anecdotally, when it comes to interest rates, I also tend to fall into this exact same category as well. I currently have 5 outstanding mortgages fixed for 30 years between 2.8 and 3.5%. If I were to sell to rebuy something else, I'd have to pay substantially more in interest to the point where it just doesn't make sense to sell. However, you shouldn't get your hopes up quite yet, because a new report from Realtor.com projects that housing inventory will experience a modest slip of 5% for 2023 as a whole, as earlier gains turn into declines in the second half of the year. How much of a drop, you might be wondering? Well, for them, home price growth is expected to fall by 0.6%. for the entire year. Of course, keep in mind that these are averages throughout the entire United States, and some locations could see a gain or a drop to either end of the extreme. Although, in terms of what other analysts are expecting, here's what you need to know. Although, before we go into those details, it's understandable that being able to save up enough money to buy a home right now is incredibly challenging. For example, one study found that it would take the average homeowner almost 8 years to save the typical 20% down payment, which is why it's so incredibly important to track and budget all of your expenses, which our sponsor Rocket Money is able to help with. For those unaware, Rocket Money is an all-in-one finance platform that helps you save more and spend less. Without exaggeration, I've been using them on a daily basis to keep track of my finances, and they routinely send me email alerts every time I receive a new deposit, a check clears, or I get a refund. They also allow you to manage your subscriptions, lower your bills, monitor your credit score, and build your savings all in one place. For instance, it's been reported that the average American spends $18,000 a year on non-essential items and $133 more than they expect in recurring charges, which to me is basically just money being flushed down the toilet. Fortunately though, Rocket Money could safely and securely identify those recurring charges and then help you cancel them with just the tap of a button. On top of that, while we're on the topic of saving up for a house, Rocket Money could help you set up a budget that automatically monitors your spending by category with notifications and visuals to help ensure that you stay on track. I also personally like their net worth chart, which gives you a clear trending timeline of your finances over time, including cash, debts, investments, retirement accounts, collectible items, and more. They're also trusted by more than 3.4 million members and growing, and this has been a company I've talked about all the time as a company I really like and recommend, even when they're not sponsoring a video. So try it out today and unlock even more features with premium by going to rocketmoney.com/Graham or using the link down below in the description to get started today. And now with that said, let's get back to the video. Alright, so in terms of what the future might hold, it seems as though most analysts are relatively in agreement, because from what I could tell, most of these projections are coming in pretty close to one another. For example, the manager of the S&P Case-Shiller Index believes that we could see a 5% decline peak to trough, with 2% still yet to recover, which is not too bad. Goldman Sachs also seconds this, with the expectation of seeing a 2.2% decline in 2023 revised downwards, or I guess revised upwards, from their previous projection of a 6.1% drop. Or we also have the mortgage giant Fannie Mae. Last week, they revised their forecast, which projects that national home prices will decrease by 1.2% in 2023, followed by an additional 2.2% decline in 2024. In fact, Zillow's taken note of this recent surge, and they have quite a different opinion than Fannie Mae. They think that 2023 is going to end the year 5% higher than where it began, and this is all because pending home sales are down 15%, which means the buyers are snapping up inventory faster than it's being listed. Of course, in terms of where home prices are falling the most, median values fell in 24 of the 50 largest US metros, with the biggest drops being seen in Austin, Texas, followed by San Jose, Oakland, and Sacramento, California, with Phoenix coming in close behind at a 7.3% drop. Now, the largest gains, on the other hand, can be seen throughout areas like West Palm Beach, Milwaukee, Columbus, Ohio, Miami, and Fort Lauderdale, all up between 7.8 and 15% from a year ago. I'm also going to link to all of the other markets down below in the description, so you'd be able to check out your own county, because I have to say, there is a huge divergence between the West Coast and the East Coast in terms of whether or not not home prices are going up or down. Now, I've mentioned all of this before in a previous video, but for those who missed it, there's almost a right-in-the-middle split between the country, with the West Coast seeing declines while the East Coast rises. Now, even though this might seem to be politically oriented, the truth is the areas that declined just so happen to be almost exactly aligned with the areas that have the highest prices. Basically, higher-priced homes have had more room to fall, or have seen a net migration out into more affordable locations, resulting in a split almost right down the middle. Separate from that, though, in terms of what the future might hold, housing economists say that there are 5 main reasons why housing prices are unlikely to budge much from what we've already seen. Number 1 is because inventory is incredibly low. Like I mentioned earlier, sellers who've already locked in a low interest rate are essentially locked in on their home unless they absolutely have to sell. This forces the buyers to bid up all the remaining inventory to elevated levels and forces home construction companies to build as fast as they can, which is unlikely still not to be fast enough. Second, speaking of builders, they can't get enough homes done. Like as you can see from the chart, new constructions peaked in 2007 and 2008, and ever since the Great Financial Crisis, home builders have never come close to surpassing those levels. Today it's said that regulatory approvals, supply chain constraints, and higher costs make it very difficult for builders to catch up, so it's likely that we're going to see higher prices for longer. Third, Bankrate says that demographic changes are creating new buyers. For example, millennials represent 43% of the overall housing market, which is the largest from any generation, and they're prioritizing affordability, slightly larger homes, do-it-yourself renovations, and a location that allows for all of this to be had at a lower price. Fourth, banks are currently offering fewer loans. That's why the thinking today is that lending is already restricted, and if they eventually loosen this in the future, that's going to be a new wave of buyers to push prices even further. And finally, fifth, foreclosures are really rare. The fact is, most homeowners only let their home go into foreclosure when they owe more on the home than what the home is worth, and that's not really happening today. In most of those cases, if a buyer could truly not afford the payments, they would just list it on the market and get a higher price than what they paid, potentially even walking away with a profit. Plus, to show you just how uncommon foreclosure activity is right now, Reventure Consulting provided a really great chart showing just how far we are below the typical trend line. And if values continue to stay high, I have a feeling that's not going to change anytime soon. In terms of my own thoughts though, I thought it would be a fun idea to look back at my past predictions to see what actually ended up happening, like this video from March of 2022. I went over all of the reasons why we could continue to see a strong market, a shortage of supply, less mortgage defaults, and rising prices. I also found it interesting that this video is pretty much exactly a year ago on July 8th of 2022. Today we could probably see some softening with a few areas declining 5 to 15%, but since real estate is highly location dependent, we could also see other areas continuing to go up in price, so it's hard to say. Or how about Jason Oppenheim's prediction last year? Because he owns the brokerage The Oppenheim Group throughout the West Coast and is also the star of the hit show Selling Sunset.
Sellers are realizing and buyers are realizing that they should buy or sell based on their own unique circumstances and whether it actually makes sense for them, as opposed to just trying to make an investment or a business decision. But the reality is this is what any realtor or long-term investor should want, is normalcy.
Right now, the biggest catalyst that I see is whether or not the Fed continues to increase interest rates, or if they cut and people feel like they could finally get a break on their mortgage. So many people have already bought or refinanced at extremely low interest rates to the point where, if history is any indication, we probably got another 8 to 10 years left before a lot of these people begin to sell. That, of course, is assuming interest rates aren't even higher in the future than what they are today. Oh, and as far as the streets named after Pokemon, this is happening in the Henderson area of Las Vegas and features streets with Jigglypuff, Squirtle, Snorlax, Charmander, and Charizard. And since millennials are right now the driving force in the market, maybe this is actually going to help them sell. Let me know what you think down below in the comment section. As always, thank you so much for watching. Big thank you again to Rocket Money for sponsoring this video. Feel free to subscribe, hit the like button. That's it. Thank you so much, and until next time.